Good evening, good evening, good evening. Hope you all are having a wonderful Sunday.
Good
I
evening,
am,
Tony.
Good evening.
oh, nice to hear your voices again. I am, hope my camera is on. I am filling in for Jessica again. She is still recovering. She hopes to be back very, very soon. Keep her lifted up in your prayers as always. And you're going to be stuck with me again for another 30 to 40 minutes. Hopefully, we're going to get into some really good stuff. And we're going to try to get out of here in about 40 minutes and try to stay on schedule this time. We always seem to go over with questions, which is not a problem. If you have them, I try to answer them. And we're just going to get into a little bit of a few things that are a little bit different today. So is everybody able to hear me okay?
Yes, I can hear you
Yes.
guys.
Yes, sir.
Okay.
We can
Now,
hear you.
tonight we're going to get into a little bit of a different aspect of the fundamental analysis. We're going to get into the relational analysis. I'm not sure if you heard of that. We're going to get into technical analysis and we're going to get into fundamental analysis, right? And hopefully by the end, you will gain some value from what we discuss. Okay. We're going to try to go through this pretty quick. But I want to go as quickly as I can to make sure that you got a good understanding. If I'm going too fast, let me know. If I'm going too slow, let me know. But we're going to get right into this and hopefully get you out of here in the next 40 minutes or so you can enjoy the rest of your evening. Okay. We're going to get into um, we're going to get into this relational analysis and how these various types can be applied to your different markets, right? But we will use the forex market as the basis for our discussion. But these concepts apply to all markets, including the stock market, the bond market, the forex market, the futures market, etc. Right? We're going to be very briefly discuss a little bit more about the USD/DXY, perhaps clear up some confusion or some questions that we discussed last time that you may have. And we're going to discuss a little bit about its role in trading and the importance of it. Then we're going to look at a few screenshots. We're not going to go live on the chart tonight, but we're going to look at a few real world screenshots, real world examples of the USD and how it affected the GBP USD in this scenario. All right. And we're going to round this all out by giving you some information about how to use this in your day trading. Okay. So relational versus technical analysis versus fundamental analysis. What's the difference and what's the point? Right? So relational analysis is also called relative analysis or comparative analysis. It involves comparing securities, sectors, or markets against each other or against some type of benchmark to identify relative value opportunities. This approach examines the relationships between different assets, such as comparing the price to earnings ratios across similar companies, analyzing sector rotation patterns, or studying correlations. We discussed a little bit about correlations last time between different assets. Relational analysis helps investors to identify which investments offer better relative value or risk-adjusted returns compared to its alternatives. Okay, so that's relative a relational analysis. Technical analysis focuses on the statistical trends derived from trading activities, primarily price and volume data. Okay, excuse me for a hot second. I got something in my eye. Sorry about that. It is a study of chart patterns, trading volumes, moving averages, and other various indicators to predict price movement. Technical analysis assumes that all relevant information is already reflected in the price movement and that history is going to repeat itself through recognizable patterns. All right. And some people are pattern traders, some people are trend traders, and some people are different types of traders. So you have to remember that that's what technical analysis is. It assumes that all the information is already presented there for you. All right. It is typically used for shorter term trading decisions. And it emphasizes when to buy and sell. Okay. So that's technical analysis. The fundamental analysis examines the intrinsic value of the securities. Okay. And by analyzing all of the economics, the financials, and the other qualitative and quantitative factors, it involves studying the company's financial statements, the industry conditions, economic indicators, management activities, and the competitive positioning to determine whether the asset is overvalued or undervalued, right? Now, fundamental analysts, when they get into things like this, they tend to believe that the market prices eventually reflect the true underlying value, making this a long-term investment approach focused on what a company is worth. And the key distinction between all three of these things is that relational analysis identifies the relative opportunities through comparison. The technical analysis focuses on price momentum and timing, and the fundamental analysis seeks the absolute value of the asset. Okay. So this is how we end up getting like this teeter-totter effect that we kind of talked about, I think it was about a week or so ago, right? Because you have this constant pulling of the market forces in different directions. One is pulling, one is pushing. For example, global events such as physical wars, trade wars, tariffs, recessions, presidential elections, and things like this. You have corporate events. You have mergers, acquisitions, earnings, analyst upgrades and downgrades that affects that corporation. And then you have economic events that deal with interest rates, non-farm payrolls, inflation reports, and then the big boy is the Fed events, the PCE ratios and the FOMC meetings and things like this, things that affect the consumer, or things that measure the effects on the consumer. So that's how we end up getting this teeter-totter effect that we discussed a little bit last week in relation to the forex market. All right. So we get ready to get into like how this applies to the market in general. And I got this in little brackets when it says forex in these little brackets, because you really can take that forex off and just deal with this as how it applies to all markets. But since we are forex based in this particular lesson right now, we're going to see how this applies particularly to the forex market. And just keep in the back of your mind that these analysis apply to all market scenarios. Okay. So we're going to get into how does it apply to the forex market, and how does it apply to the forex market, and kind of lost my train of thought there. And let me back up a minute. We're going to get into how does it apply to the forex market. Basically, it involves exchanging. The forex trade involves exchanging one currency for another. And this makes it a fundamentally different than the stock market, because you're always trading two things against one another. For example, you're going to be trading the Euro USD, the JBP against the yen, rather than trading individual securities. And because you have these two things always trading against each other, it's easier to understand and visually see the pulling and the pushing of the market forces against each other, against the asset. So, anybody got any questions so far? Everybody's good?
Yes.
Yes.
Okay. So when we get into the relational analysis in the forex market, how does the relational analysis then applies to the forex market? Okay. We already discussed that it involves comparing the currency strengths across multiple pairs. It helps us to identify the strongest and the weakest currencies. And rather than analyzing individual pairs in isolation, successful forex traders are going to examine the currency indices and cross-pair relationships. All right. And by this, I mean, if you like, say for example, you are evaluating the USD and this USD is strengthening against like the euro, the pound, and the yen, and they all doing it at the same time. This is going to suggest that that there's broad strength in the USD rather than weakness in the individual currencies. And this is going to help you choose the most advantageous currency pairs to trade, and it's going to help you avoid conflicts in your trading. So it doesn't necessarily mean that the other currencies are getting weaker. It just necessarily means that the USD is just getting so much stronger. Maybe they had some interest rate news that came out that's positive. Maybe there was some tariff news that got, in today's age that got reduced. And maybe he put a pause on something. So that's kind of the things that will strengthen the USD under this regime with the Trump administration. I see I have a hand up.
Yes. Hi, Mr. Tony. I have a question. You mentioned that if we're looking at, let's say, the USD it strengthens against JPY, pound sterling, and let's say a third currency. Are we looking at we wouldn't look at the DXY because the DXY is looking at a bunch of other different currencies. So what exactly are we looking at? Are we just looking at the pair and seeing how, the strength of the dollar against these other currencies in the actual trading pair? Or are you using something else to compare the strength of the Japanese yen against the US dollar or the pound sterling against the US dollar? I just want to make sure I'm not missing something.
You're not missing anything. What we're looking at is the strength of that dollar against whatever currency pair that you're trading it against, right? And basically you can really just look at, if you're looking at a chart, and we're going to get into this a little bit later, you can look at the DXY and you will see whether it's strengthening or weakening. And then you will know, if you understand those relationships that we discussed last time, the inverse relationships and the correlated relationships with the DXY,
Right.
you would know which way your asset is likely to move. But you're comparing those two things together. And that's why it's easier in the forex market to do this, because you always have a point of reference between one thing and the next thing. And we're going to get into that a little bit later. Hopefully, once we get into it, it'll clear up some of your questions.
Okay.
Okay?
Thank you.
Oh, you're welcome. Who was next? Donna's?
Hey, yeah. I don't know if you're gonna touch on this later or if this is even a topic for the day, but I was curious how that correlates to say like gold or US 30, you know what I mean, or those type of uh, options.
What you mean? How does what correlate? The different types of analysis?
Yeah, like how we use the DXY to analyze pairs, right? Is it pretty much the same way we would use that to analyze gold as well and US 30s? I don't know if my question makes sense.
Yes. The short answer is yes. You would use the DXY to analyze. You can use the DXY to analyze against any other market. It says it right there on the screen. You see where it says relational analysis in forex and any other market right there?
Yeah.
Yeah, you can use the strengthening and weakening of any currency, particularly the DXY in this case, against any other thing that you're trading.
Understood. Understood.
Okay? Oh, you're welcome. All right, we're going to get into it a little bit. Hopefully, once we get down that far, it clear up some of your questions and concerns. Okay. Let me see, where were we? Let me see. We were at relational analysis. Okay. Technical analysis of forex and any other market works exceptionally well because the market has high liquidity and it trades nearly 24 hours a day, right? And this creates a cleaner chart pattern and a more reliable technical signal, okay? And the Forex market is what, 7 point something trillion dollars a day, right? So, which means the technical levels are respected by institutional traders, right? Because it's such a big market, right? So the common patterns like support and resistance, trend lines, if you use Fibonacci, all of those things are effective. All right. However, the Forex requires understanding the currency pair correlations. We've discussed just a little bit ago, and we discussed again about a week or so ago. All right. And you need to know the correlation between the Euro USD, the pound USD, and they often trade together, right? While the USD shelf typically moves inverse to the Euro USD, right? And if you put these things on the chart, you can start to see how they move, and not only in relation to the DXY or the USD in this case. We're just going to use USD because I think it's the terms that we use when we trade in Forex. DXY is what we use when we trade other things, but we're going to use USD for simplicity. Okay. And then when you look at how it moves in relation to the USD, in relation to the other assets, you'll start to see patterns unfolding in the behavior of how these things respond when the USD gets strong and when the USD gets weak. And then you apply your technical analysis to your entry exit points, your buy sell signals, your trend line scenarios, whatever it is that you all use, you apply all of that once you get the understanding of how these assets are affected. Okay. So when we get into the fundamentals analysis in Forex, and it applies also to any other markets, right? It becomes critically important because the currencies in the Forex market reflect the economic health of an entire country, right? It's talking about the central bank policies, the interest rate differentials, which we talked about a little bit about the countries wanting to maintain parity with the U.S. Fed. We talked about that a little bit. So when the U.S. Fed raises rates, the other countries tend to raise their rates as well to try to maintain that interest rate differential or that parity we discussed. We talked. You start looking at things like the GDP growth. You look at employment data and like political stability. Which people are really concerned about right now. It all that directly affects the fundamental analysis that goes into evaluating currencies in the Forex market. Unlike the stocks, where you have company-specific factors that dominate, the Forex focuses on macroeconomic indicators, okay? And the key difference is that the Forex requires the understanding of international economics, central bank policies, and global flows. And it makes the analysis more complex, but it's also more predictive than when you're doing individual stocks, right? And we talked about the size of the thing. Oh man, it's been a long time ago. But the bigger it is, the more impactful it's going to be. And the Forex market is bigger than an individual stock, individual company, right? So it's going to have more impact. It's going to have more uh, directional push when you get to understand these things. Okay. We talked a little bit last time about the fat kid, skinny kid on the seesaw, right? And we're going to get into that a little bit. Hopefully we can clear up a few things that may have caused some confusion or things you may have questions about. So we're just going to assume for the time being that when you come into the market on any given day, it's going to be equilibrium. Equilibrium is balance. It basically means that all players are coming to the table with equal footing, equal strength, equal influence, and there has been no price movement either way, up or down. When you come into the market like this is the initial stage where your market analysis pretty much begins. It is performed to determine the possible outcomes, shifts in directions, and the initial trading decision. On a chart, it won't look like this. It's going to look like consolidation, or it's going to be a ranging market. It's going to, it's going to be in a tight range. It's going to be in a wide range. And when you see those ranges, the market is in balance. It's in equilibrium. It's consolidating, right? When it's out of balance, that's when you're going to get your price movement up or down, right? So when we get into the different, when we get into market analysis, it's really composed of your relational analysis, your technical analysis, and your fundamentals. And this is where you determine your possible outcomes and your shifting directions, okay? Now, it's important that you remember that you evaluate all three of these areas to get the very, very best understanding that you possibly can. Now, you can get a very good understanding even if you don't evaluate all of these. Maybe you're a fundamental analyst, maybe you're a technical analyst, maybe you're a relational analyst, and you're going to get a good understanding if you evaluate them individually, but you're really going to get the best understanding if you understand how to evaluate them together and how they fit together and complement each other, right? So there's nothing wrong with being one or the other, but it's good if you understand all three, right? So this is the example that we kind of went over last week. We talked about a fat kid, skinny kid on a seesaw. So basically in this scenario, we're comparing the GBP against the USD. A strong USD versus a weaker GBP. Now, after you've done all your analysis, particularly your fundamental analysis in this case, the USD has become strong, i.e. it's become fat, it's become big. I call it the fat kid, skinny kid on the seesaw. So in this scenario, since the USD is gaining strength, the expectation is that the GBP will begin to move bearishly. The GBP USD will begin to move bearishly, since the GBP has an inverse relationship to the DXY. Knowing that this negative correlation exists, it is possible to just wait until there is some sort of catalyst. And they use the news as the catalyst. That's how they communicate with each other. They're not really talking to us. They're talking to each other. But since we're eavesdropping in on a conversation, once we understand the catalyst that they're using and how to apply it, we can apply that to our trading, right? Now, these correlations are not always one-to-one, right? They may be close. They may be 1 to 0.7. They may be 1-to-1. They may be 1 to 0.9. Basically, all that means is you may get a small shift, you may get no shift, or you may get a delayed shift, depending on the market sentiment at that time and everything that's going on in the world, everything that's going on in trading, everything that's going on in investing with corporations, whether it's good news or bad news, or whether it's earnings season, whether it's, it's the tariffs are going up or tariffs are coming down, right? All of that has to be taken into consideration before you go to your technical charts and make a trading decision, right? So never forget that you always have to make sure you have your setup. Even if the fundamentals are telling you everything is hunky-dory, green and gravy or whatever the term, just make sure you always get your setup right, okay? On the flip side of this, if we got a strong GBP and we got a weak USD, the tendency is for that market to move up in a bullish pattern, right? Because now the fat kid or the strong kid is the GBP. The dollar has gotten weaker, right? So you're going to get this inverse relationship push, right? And knowing all of these correlations, knowing these relationships and how they fit to each other, you can make that correlation whether the market is going up or whether the market is coming down. You can trade this in both directions, right? And that's why the correlations are so important, right? So we're going to get into a couple of real world examples. We're not going to go on the live chart, but I did take some screenshots. And these screenshots are pretty much, I think this was on like the 16th of May, right? On the left, you got the DXY. On the right, you got the GBP USD, right? Now, there was some catalysts that happened that day that shifted the USD in a bullish direction. I don't know what it was. I didn't look, but you can clearly see there was a shift. Now, the chart that we're looking at is on the H1 chart, but you can see this on any time frame. It's just easier to see on the H1 chart for educational purposes. At the same time that that DXY shifted at 3 o'clock, we had a shift in the GBP USD, right? And it started to push bearishly. There's that inverse relationship that we were talking about. Now, at 3 o'clock a.m., right? That is the beginning of the London trading session, right? Perhaps there was some news that came out in the Asian session or maybe even the London session, or maybe the asset needed to complete its cycle, or maybe the market needed to complete its cycle. Whatever it was, it shifted the direction of the USD to the bullish side, which shifted the direction of the GBP USD to the bearish side, okay? On May 22nd, I think that's May 22nd. Yep, May 22nd at 1400. Okay, there was another catalyst. This catalyst shifted the USD to the downside. And conversely, at the same time, it shifted the GBP USD to the upside. Now, I don't know what happened, but you can clearly see that's what happened, right? I got a question in the group.
Hey Tony, just wanted to ask really quick about those shifts that happening. It's always gonna be one of those red boxes on the news. Usually those big moves.
I can't hardly hear your question. I'm sorry.
Sorry, I have a lot of people. Just a second. Sorry, Tony. So those big moves, there's always gonna have those red, like you were talking about the red folds that we always should take a look at. Since they're red, they're very major news. So those moves, the big moves, usually gonna be with those red folders that we should pay attention to.
I wouldn't say always. I wouldn't say never. The stock market doesn't always do anything. The forex market doesn't always do anything. But the probability of high impactful news is going to come from those red and orange folders. Right?
Okay, thank you so much.
Those are going to be some of your bigger moves. Now, just because you have a red or orange folder doesn't necessarily mean that you're going to get a move at all. The market could just be muted that day, right? I mean, for any number of reasons. Maybe they're waiting for some bigger news to come out, or maybe the market is overextended and they're just tired and people are just taking a break. Maybe it's a holiday weekend. Maybe, you know what I'm saying? Maybe, you know what I'm saying? It could be any number of things why you could get a push or not get a push. The only thing that those calendars and the economic news are telling you, and remember, that's only the scheduled news. That doesn't have anything to do with the random tweets that we get these days from different media outlets, so social media outlets. So the only thing that's going to tell you is what you can expect at a certain time on a certain day, not that it's necessarily going to happen. So don't just take that oh, I got a red folder or orange folder, I'm about to get a move. Doesn't necessarily happen that way. Okay.
Okay, thank you so much.
Oh, you're welcome. Okay. Day trading. I got that in brackets again. So you can really just say these are how does it apply to trading applications, right? How do we apply this to trading? Not just day trading, but we're going to talk about day trading in particular. Okay. See, I got a question from Catherine.
Yes, Mr. Tony, this is weird. I just want to ask tonight, your meeting tonight, your class tonight, will it be downloaded so we can see it, look at it later?
It's going to be on YouTube.
Oh, okay, then I'm set. Thank you.
Oh, you're welcome. All right. All right. Relational versus technical versus fundamental. Here we see this again, right? And day trading, I don't know how many people day trade. I'm assuming some of you, at least some of you day trade. It involves the buying and selling of securities, within the same trading day, requiring rapid decision making and different analytical priorities. And it's very, very different than long-term investing. So I'm assuming most of us day trade at least some other time. Relational analysis in day trading, okay? It helps to identify the best trading opportunities among the available options. We remember when we get into relational analysis, we're trying to see how something is performing against something else, right? How is this company performing against some other company, one of its peers, for example? So we compare the relative strength between the stocks, the sectors performing better than the other, or the overall market, and the correlation. And we go again with the correlation relationships between those assets during periods of market stress. Okay, they might trade strong stocks in strong sectors while avoiding weak performers. Now, some people may avoid the weak performing assets, but if you understand how to make money going up or how to make money going down, you're not necessarily avoiding those weaker performing assets. So we basically use relational analysis and trading currency pairs based on their relative economic condition between those countries. So, and what's affecting those countries at that time, like I said before, it might be interest rates, GDP, tariffs, or any other thing that those two countries may be into or maybe even getting out of, okay? So when we get into the technical analysis, this basically becomes your primary tool. Since day traders need precise entry and exit points. You know, we use intraday charts, maybe the 1 minute, the 5 minute, or the 15 minute, whatever chart you use. And this helps to reveal short-term price patterns, momentum shifts, and volume spikes. We rely heavily on indicators like moving averages or trend lines for direction. We rely on things like RSI for overbought and oversold conditions, or even a MACD for momentum changes. Now, these chart patterns, like the breakouts and the flag formations and the support and resistance levels, they provide actionable signals. And sometimes it's within hours, sometimes it's within minutes. And then we use volume analysis, and it becomes very crucial since high volume validates price movement. And this is where you get into like the institutional traders, the institutional players. When you start to see like high volume activities and a chart is really starting to move, that's when the institutions have come into the game, right? Because retail traders, we're not buying enough at any significant amounts at any point in time to move the charts like institutional investors. So when you see those big shifts, that's when the institutions have come into the game to play. Okay. So don't ignore when you see those shifts. Okay. The fundamental analysis in day trading, it has a limited direct impact, but it does provide some essential context. Okay. So major earnings announcements, the Federal Reserve decisions, or the economic data, it releases periods of volatility, and it creates opportunities that we exploit as day traders. But the traditional fundamental metrics for day trading, like PE ratios and all that stuff, it has no bearing in day trading for us, because that stuff looks at the longer term outlook of a stock, whether you're investing in it, whether it's strong or whether it's weak. Okay, so we as day traders, we focus on the news catalysts. We focus on the earnings surprises. We focus on the market moving events that create temporary price movements. Okay, so we don't really get into like the PEs and the long-term investing strategy. We leave that stuff for portfolio building and when you're holding assets for longer periods of time. Now the key difference, all right, is time, the time compression. when you're day trading, you must make decisions very, very quickly. You know, you got to make them in minutes or hours versus institutional investor or long-term investor who making decisions that's gonna go for months or years, right? So you're going to be using your primarily your fundamental analysis and your initial analysis for context here, right? So it becomes more important to know what the catalysts are when you're day trading, right? When they're likely to occur, what the possible impact is going to be, what kind of movement are you expecting out of this asset at this particular time. Okay. Now, that's pretty much the end of the presentation right there, right? If you got any questions, I might have some answers. Other than that, I don't have anything else to give you guys right now. If you got any questions, please speak up. If you got any comments, I'll take them. We're gonna.
I do have a question for you, Mr. Tony. So do you as far as your trading style, do you use one over the other, or are you kind of in between? You use the fundamental and technical.
I rely heavily on fundamental trading as my catalyst because I understand what the catalyst for any given asset is. But once I determine what the catalyst is for the day or what I expect it to be, I then turn strictly to my technicals, right? I do relational analysis a lot of times when I'm portfolio building, when I'm comparing one company against another. Is Apple a better buy than Amazon, or is Microsoft a better buy than NVIDIA? That's when I get into my relational analysis because I'm looking for a long-term hold, right? But when I'm doing my shorter term analysis, I go through those things. A few weeks ago, we talked about all of those websites and things that I go through
Yes, I
in
remember
my
those.
analysis. I follow that to the T every day. In the order that I gave them, in the sites that I gave, that's what I do every single day. Right. Even before I get into my chat rooms or even before I look at Facebook or anything like that, I look at what's going on in the markets from a top-down approach. I see what's going on at the higher time frames. I see what's going on all the way down to the lower time frames. See what news is coming out, who might be speaking. I try to stay abreast of what 47 is doing because he is unscheduled a lot of times. He's not on anybody's calendar. So you got to take that into consideration, the uncertainty and the sporadic nature of this administration to tweet or to respond off the cuff, because that could fundamentally change your scheduled economic events. You know, just the other day, he came out and put 50% tariffs on the EU and said they're going to take effect in what, June, which is a couple of days.
Yeah,
And then,
June 1st. Yeah,
and
he did
yesterday
say
he pushed
that.
it back to July 9th. Or was it today? I can't even keep track, right?
And then he said he wasn't gonna put tariffs on Apple, but then he turned around and said he was gonna do 25% if they didn't build in the US. So
Yeah.
yeah.
So those are unscheduled events. And right now, because of, the economic condition with inflation being high, with natural disasters happening around the world, and particularly the United States, with consumer confidence down, anything that affects the market and dealing with these tariffs is going to have a profound impact because it just adds more uncertainty to what's really going on in the market. So you have to be mindful of the things that are not scheduled. Listen to what people say, and then also listen to what they don't say, right? And that's going to take some time to develop that. What were people expecting them to say, and what did they not say? Right? That's going to come with a lot of reading the news and understanding the news and the catalyst, and it's just going to take some time. So, just be mindful that you may not be there just yet, but just keep watching and reading it, and it'll become second nature to you. Thank you for
Yeah, yeah, I do watch the Bloomberg. I just kind of keep it in the background, and it does give you very informative information. Um, Pretty much 24 for all the markets. So that's great info. Thank you.
Oh, you're welcome. I think Tradina was next.
Hello, Mr. Tony. Thank you for teaching us this evening. So I was wondering, just like we have the DXY for the dollar, is there an index for the pound?
I think it's GXY, I think.
Okay.
I have a list of them, but I don't have them handy. But yes,
Oh,
every currency has their ticker. I just don't know what they all are right now. I think
It's
the
the
pound
BXY.
is the BXY. It's the BXY.
oh, BXY. Okay.
Yes, it's the
All right.
BXY.
All right.
Yes.
Thank you.
Oh, you're welcome. Stacy is next.
Yeah, I just had I guess more of a personal question. I think when one of the calls you had, I think one of the earlier calls, you mentioned that you don't trade currencies as much these days. And I guess you focus more on equities. And I was just curious, just to understand, what led to that decision, if you're open to sharing.
Equities pay better.
Oh, okay.
When stock the forex is easier, all right. But when you get into highly leveraged assets like options, stock options and things like that, they pay better
Mhm.
because they're highly leveraged assets. Now, forex is leveraged too, and you can leverage forex assets, but but if you're in a U.S. broker, you're limited in your leverage. You have to go offshore and risk your money with an offshore broker in order to get really, really high leverage for forex. 50,
Mm,
500 to 1 and all this kind of stuff. You can't do that inside the United States.
uh-huh.
All right, they
Okay.
won't let you do 1 to 500. But the short answer is the more risk you take, the better your pace.
Okay. I always thought that the Forex paid better than the equity. So, but thanks for letting us know that.
Yes. Yes, as you step up,
Mm,
you step up into, and it's a little off kilter, but you step up from forex, you step into stocks, you step into stock options, you step into futures. As you
mhm,
step up into the riskier asset classes, you're going to get
mhm.
paid.
Okay.
Okay?
Thank you.
Oh, you're welcome. I think that was Jonathan. Who's next? With the Stacy? Stacy has a hand raised, but I might be on Jonathan. Who's next?
Yes, sir. Thank you for taking my question.
You're
Um,
welcome.
so when analyzing fundamentals for gold, what key economic indicators should I prioritize weekly, and how can I tell which events are likely to cause a strong reaction versus a muted one?
It's a very good question. We used to use gold as a primary indicator because it trades mostly 24 hours a day. The problem with gold is the correlation, right? The correlations is not really one-to-one with any asset. I mean, it is at various times, but it's not consistently one-to-one, which basically means you may get a severe movement in gold and nothing happens with your asset that you're looking at, right? So we stopped using gold, and guess what? We started using. Let me give you one guess. You're not
US
gonna,
30, NASDAQ? I'm not sure.
you started
Bitcoin.
using. We started using USD.
Okay.
We've been talking about it a couple weeks now, maybe a couple months. USD. So when you look at the USD, you will see correlations in the strengthening and weakening of that asset against the strengthening and weakening or whatever asset you're looking at. The issue is you're going to have to know the correlation. We mentioned correlation like 3 or 4 times in this presentation just today. The correlation. How is my asset correlated against the other asset? How is the GBP correlated against the USD? How is the pound correlated to the yen, and vice versa, right? How is that correlated to the stocks that I'm trading, or the stock option that I'm trading, or the forex, or the futures that I'm trading? How is this movement in this asset correlated to the DXY USD? Is it inversely correlated? Is it positively correlated? How closely correlated it is? Is it 1-to-1? Is it 1-to-0.9? And that correlation is going to change based on the market sentiment and the volatility and the catalyst that's happening that day. So it may start off being like a 1-to-1 relationship on one day, and that same day it may go down to 1 to 0.5 because the market has shifted. So when we start talking about trading, especially particularly the day trading, we're talking about short-term trading decisions, right? And by short-term trading decisions, I'm basically saying, 15 minutes to an hour, right? And if you're really feeling really good about it, you're going to jump down to the lower time frames. Now, to make your trading decision, we always jump to that lower time frame to make trading decision. When you see your setup, whether you're using your technical analysis. Remember, we discussed that the technical analysis is where you make your entry exit decisions, right? The fundamentals is where you make your what is it going to do? I think what it's going to do decision. I think because this is positive news and they're expecting positive news. If it does this, this is going to do that. That's where your fundamentals come in. And once you get that understanding, then you jump over to your technical, and then you look at your entry exit points, whether you're trading trend lines, whether you're trading Fibonacci's, whether you're trading whatever indicator you're trading, however your setup looks to you, you make that on your technical side from whatever time frame you're trading on, whether it's a higher time frame or a lower time frame.
Okay. Thank you so much.
Oh, you're welcome. Annette.
Hi. I just have a quick question.
Yes.
Do you think it's a good time to invest in the Vanguard Tech ETF, the VGT?
That gets into investment advice, and I can't get into that.
Okay.
Investment advice. Sorry.
Okay, thank you.
Oh, you. Anybody else before we get out of here? All right. If nobody else has any questions, I would really appreciate if you all take the time to make comments on the presentation today. I really look at those and I take your comments to heart and make any improvements that I need to make in my presentation so I can make sure I'm getting you the right information at the right time. So if you don't have anything else, we're going to get out of here. Remember to keep Jessica lifted up. She's going to come back as soon as she is able to come back. But she's thinking about you. She's concerned about you. She loves you. She wants you all to be okay. So we're going to make sure that she's going to be okay as well. All right. So
we appreciate you.
Oh, you're quite welcome. You're quite welcome. All right, you all. We're going to get out of here. You all have a good evening, and we'll do this again if we need to. If not, then we'll be in touch some other kind of way. All right. You all
All right,
take
thank you.
Mr. Tony.